Hello, hi everybody. Hello, good evening everyone. Ethan here for Investing Note. How's everybody doing? Right. Okay, we probably can't hear them, but yeah, we see more and more people coming in. Hope everybody is having a great evening so far. Okay, let's just give everybody 1 minute, right? Okay. Right. So thank you everybody for joining us. Right. So this is CSOP's exclusive second half of 2022 outlook. All right. Today we have two special guests. Right. Adrian Chew, who is the Vice President of CSOP Asset Management. Hi, Adrian. How are you today?
Hi. Good evening. Thank you all for joining us tonight.
Awesome. Awesome. And we have Bruce. Right. Fixed income portfolio manager. Hi, Bruce.
Hi, good evening, everyone.
All right, awesome. So I think today's webinar, this outlook is going to be very comprehensive. We're going to cover global macro, Hong Kong, China, and Singapore as well. All right. So I think without further ado, let's just begin. All right. So a couple of stuff, right? So I'm going to introduce our speakers formally, right? Of course, Adrian, Senior VP at CSOP Asset Management, right? So I think we have, many webinars before with Adrian, and he's quite a household name in this industry, right? So I think for him, he has done, so many of these webinars with us, and I think many of our audiences has also heard what he has said in the previous webinars. So heads up to Adrian, right? So next we have Mr. Bruce Zhang, right? Portfolio manager at CSOP Asset Management as well. So I think Bruce specializes in fixed income investments, right? So Bruce, you're actually a CFA charter holder as well. Yeah, that's awesome. So let's begin, right? So before we begin, let's go through the disclaimer first. So this is mandatory, right? So of course, for the purpose of this webinar, whatever we're sharing here is actually for the purpose of education. All right. Okay. Quick one. So let's take a look at what this outlook will be focusing on, right? It will be focusing on two main aspects, like I said earlier. So growth play, China and Hong Kong markets, and also dividend play in the later part of the webinar, which is more focused on the REITs in Singapore. Okay. So guys, if you have any question along the way, please put it into the Q&A section for Bruce and Adrian to answer at the end of the webinar. Okay, so let's move on. All right, so I think the very first thing before even we start talking about specific markets, right, we are actually against the global backdrop of quite a bearish market for stocks, right? So we have high interest rates, we have high inflation, and there is a growing risk of recession, right? So, Adrian, right, can we get an understanding of what's actually happening? Can you probably share more with us?
Yes, Ethan, yes. Thank you so much again for the kind introduction, and thank you all for joining us tonight, giving us a precious opportunity to share both not only the outlook on the growth side, but also on the value and of course the income yielding product itself. Right. So Ethan, it's a very valid question right now. At CSOP, we believe that as the US Fed tightens their monetary policies, we believe that the recession fears and risks have also definitely increased, right? As the monetary tightening, hope to tame the inflation that is actually experienced by the US economy. It's actually to try to tame the demand as they reopen their economy. As this, when the inflation has gone out of whack, I think the Fed being desperate definitely wants to also increase, their interest rate hikes and turn more hawkish and trying to clamp down inflation. I think for Fed itself, inflation is actually more a tricky word rather than recession. And having said that, I think the recession risk is definitely rising. So even though now we do not see any recession already happening on the global economies, but for sure, both equities investors and fixed income investors are pricing this in the near term in terms of recession coming, and you could see that actually the yield curve has actually inverted. And in history, when yield curves inverted, means that there's an impending recession going forward. And to say in terms of valuation, the adjustment for valuation for the first half has been revised downwards. So the earning forecast right now for the second half for US stocks in terms of consensus, that we could see a downward revision in that sense. So that probably set the tone in terms of recession fears for the US economy. The next slide, please. All right. And having said that, we are, the US growth outlook is definitely in CSOP views believe that it is going to be a less favorable going forward to inflation's starts to taper and starts to come down. But we believe that it's going to be pretty sticky as well. It's definitely not transitory like what the Fed believe going forward. So in the past year, due to the ultra easing policies, to boost their own economy and to prop up their stock market, that era is definitely over. With the sticky, CPI, the consumer price index, in terms of, and mostly what caused the CPI to go is actually due to gasoline prices within US going up really quickly. All right. So with that surging, the US Fed turning more hawkish, and hence that's the reason why we believe that the US economic growth outlook has turned less favorable. Yes.
Right. Thanks, Adrian, for sharing. So I think everybody sort of have a idea of what's going on in terms of the global macro. So the next question, right? Let's shift our focus to the China situation, right?
Mm-hmm.
Right. We know that for China it's a little bit more different, right? So Adrian, can I get your help, right, on
Yes.
helping us to understand what's happened in the past for China and what's going to happening in the present?
Good. Yes, I mean, I think like what Ray Dalio said, what makes his decision in the forward is definitely looking what's happened in the past, right? And this is actually one of the key a slide to really give us a sense of why and how do we get to this part, right? In 2021 and 21, that's where US struggled to control the COVID-19, the pandemic, right? And the Fed starts to inject liquidity into the market on top of what happens for the previous 10 years. We were actually propping up stimulus packages. We were just giving out liquidity, just propping up from the great financial crisis. And now, with 2020 and 21, they're putting more liquidity, to inject, just to prop up their economy and just to, support their stock market. And in the same year, in 2020 and 21, China being the epicenter of the outbreak of the COVID-19, right? They were the first in, they were the first out. They managed to control the outbreak successfully. And then workers are back to work very safely, and supply chain remains intact. Now, 2022, this year, right? And China is still having this zero COVID policies. That actually has caused intermittent disruption to the supply chain, and hence, cause a bit of a spike in terms of inflation. That's because US already, has moved from a pandemic to an endemic, and they have opened its economy. Western countries, even us in Singapore, we have actually, opened our economy, and everybody's, traveling and consuming, a shift towards the endemic phase. And hence, with that increase in demand, being fueled by the intermittent supply chain disruption within China itself, plus the Ukraine Russia conflict that helps disrupt the commodity prices and everything. So that's how we are today. The Western countries and ourselves, we are seeing a very high inflation. And for US itself, they have actually, we believe they are actually at the peak of the growth cycle. They just recently they have announced their annual inflation rates actually at 9.1 as of June, highest in the last 40 years. And we also got some confirmation and some kind of comfort that the US Fed will definitely stick to a benchmark interest rate hike of 0.75 basis, will not follow Canada and do a crazy 100%, 100 basis points increase. So we believe, in July we still stays at a 0.75%, and that's definitely the second largest, back-to-back largest increase since 1994. Right now, for China, they are still within that very strong stance to have zero COVID policies within China itself, and for them, the inflation pressure is not great in China itself. On the contrary, it's very subdued, and the evidence shows there's a mild incremental kind of inflation, the CPI, at 2.5%. And then, and also a moderation of their producer price index PPI, thanks to slowing recovery of their domestic supply chain, as they release from their Shanghai lockdown itself, right? And on top of that, they are also importing discounted oil exports from China, and according to the Chinese custom, the price per ton from Russia itself in June was at US dollars $914. That is about 18% lower than the oil price, which are quoting over $1,000 from Saudi Arabia. So that spread is about 18% difference in spread, and that's actually the widest spread on record right now. So they're actually having importing very cheap fuel from Russia itself. Hence, their inflation is actually very low. And so, in fact, right now, for the second half of GDP for China has only increased by 0.4%. So, concluding, the first half of this year, their GDP growth is actually at 2.5, far below from their official target of 5.5. Right. And the next slide, please. And having said that, so I just want to see right now the first half of the the market review, and commodities, dollar has actually the only two asset classes has actually outperformed or having a positive returns, while we could see that both fixed income and equities saw huge retracements in that sense. Yep. So having said that, with that retracements, we believe that equities and fixed income are at a fairer valuation right now, and also having at an attractive kind of yield levels at this current moment. To you, Ethan.
Right. Thanks, Adrian, for sharing. I think this one we've seen, almost everybody, right, from the on the right hand side of the chart right now is being better year to date.
Yes.
Right. So the next important question, right, in terms of market cycles, where is China right now?
Right, the next slide. So, I mean, right now, definitely the pressing issue for China is actually a deceleration in terms of growth, right? A 0.4% increase, and in the first half is only 2.5. It's actually very, very far off from the official target of 5.5. And having said that, with these headwinds that we experiencing right now, and rightly say so, that we're actually on the right hand side of the whole spectrum of investable asset classes, there are three opportunities right now for China, right? The potential reduction of tariffs on Chinese import by the US Biden administration. That's one potential opportunity. The gradual relaxation of the zero COVID policy stance across China. So right now, they also have introduced, to half the quarantine. So that's again a good sign, a positive sign from the Chinese government, right? And also the trickling down positive impact of the fiscal stimulus on the real economy should definitely surface out to be more prominent in the economy in the second half of this year, as we can see, uptake in terms of corporate borrowings and infrastructure spending. So these are the three opportunities. And next slide, please. Yep. So we can see there are more stimulus on the way, both physical and monetary. And having said that, the physical revenue for China actually dropped by 10% for the first half, mainly due to the COVID impact, and due to the stimulus policy by adding value added tax credits and tax refunds to corporations. So a policy-induced reacceleration is expected for China in second half for the rest of this year, in fact. And definitely, the fiscal stimulus will definitely see potentially be the largest boost for growth for China to hit that 5.5% mark. Right. And on the monetary side, we expect China to be actually on the easing stance, going to give up more kind of a support, because right now their inflation, right, remains very manageable in contrast to US, right? So they are not constrained by that in that sense. Therefore, they still have the capacity to actually inject more monetary stimulus to prop up their economy, right? So given that the economic growth for the first 2 quarters is definitely well below their target, definitely they have a pressure to achieve the full year of 5.5 economic target growth. All right. So we believe these are two ammunition that they have right now, and without the constraint of the inflation numbers, these two will definitely help to support the Chinese economy. Right, the next slide, please. Thank you. Right. So because of the physical stimulus, right, we could see the increase in terms of the corporate borrowings, and you could see that, comparing 2021 and 22, you could see that the corporation side, the institutional side definitely is on, has actually benefited from the fiscal stimulus. However, we need to see such liquidity to go to the right-hand side of the chart, which is actually to the consumers, to the household. And we also saw that, there is an inverse relationship between the number of COVID cases in China versus the retail sales. So when the COVID numbers come down, retail sales definitely would recover. And we're starting to see a trickling down effect to the domestic household. And you could see that right now the lockdown has been lifted, and you could see that retail sales has actually rebounded as the new COVID cases has declined.
Right. Thanks, Adrian, for sharing. So
Yep.
I think it's an interesting phenomenon where, the COVID cases come down, then we see, retail sales go up, right?
Yep.
Because, for at least for the case of Singapore, we don't really have that kind of, or at least the media does not actually highlight the kind of data or,
Yep.
right? So, the next question is, what are the possible scenarios right now? Is the worst over for China? What do you think, Adrian?
Wow, that is definitely the magic. That is the answer that most of the investors would definitely want to hear. Definitely the worst is over. But we believe that the worst is over because of the signs that actually been going on to the market. And the next slides, please. And we believe that the ice is melting, right? We could see that the export growth for China is actually about 18% year on year for June, beating the estimate of 12%, right? And so that means, with the market, with China releasing the quarantine, and people are going back to, to work, and supply chains are back online again, and you could see that there is actually a huge export for June, right? And this is actually due to the relaxation of the COVID-19 control measures, both in Shanghai and in Beijing, right? And on that note, on the import side, imports for China only edge up only 1%. This means they are exporting. That means they are selling more. They are importing less. So I think the imports is definitely not that important, but you could see that edging out of 1% means they are also consuming just to create export and end product to be exported. So I think the import is not that important because they have already probably a few months of amassing imports due to, and no one's actually using this raw material to create into the end product due to the lockdown. But I could see that right now with people coming, and we're trying to fulfill orders, and we could see the export is actually aging higher, so much higher than imports. And having said that, exports and imports, the next slide please, you could see that the China is actually having a record high surplus. That means, they're financially, they're actually doing very well. They're actually having a positive in terms of their current account or balance sheet, right? And they actually hit a record high of about close to $98 billion in June for 2022, right? Up from 15 billion in the same month a year earlier. Right, and a trade surplus with US is actually widened to 41 billion. So that means you can see that a large consumers is still the US, and they're still consuming from China itself, and hence that's the reason why Biden has to definitely remove those tariffs, right, just to hopefully that's what bring down the inflation within the US itself. And having said so, yes, so definitely we are looking for China for growth going forward for second half this year, while the Western countries are occupied in tightening their, to tame inflation, with the inflation risks for the Western countries and for US itself. China's reopening and with that stimulus, going on is definitely a key to avoid recession within China itself and returning to growth, showing a bright spot in terms of the global economy. China is the place to be right now, and highly, highlighting, its relative advantage compared to the rest of the world. So I think I think China is actually facing a low consumer price, definitely give you a favorable position for growth and for allowing inflation to return for China itself. Yes. The next slide, please. So again, we see that ice is definitely melting. In the earlier slide, the retail sales domestically has actually rebounded after the new COVID cases has actually declined. And what's actually popping up and pushing these retail sales back up, you see that it's actually being supported by the online part. The online retail sales are actually propping out and recovering so much faster than the retail versus the total retail sales growth. Right, we're seeing an increase in terms of the retail sales is actually driven by online retail. So definitely the technology sector is still very instrumental when it comes to retail sales in China itself. And the next slide, please. So, we talk about the technology, and, technology, probably some of the questions that the audience will probably ask is that, for the last 2 years, we're looking at very strong regulatory concerns and regulatory clampdown from the Chinese governments. But there are many kind of telltale signs within the announcements and the steps taken by Chinese government that the regulatory concerns may be fading. Right, there are a series of easing and signs that the Chinese government still needs the technology to prop up their economy. Right, if, for example, in April 29th, their meeting has actually vowed to promote healthy development of platform economy, completing the special ratification of the platform companies, bring supervision for this economy so back to normal, and introduce a specific measure to support the healthy development of the economy itself. And the gaming itself, in July, July 12th, right, they also issues like new 67 game licenses, right? So you could see that they're actually easing in terms they're more adaptive they are actually giving up positive signs for the internet sectors and platform economies. Right, the next slide, please. Yep. So I think these are some of the screen capture, like they vow, China actually vowed to reignite their market, by supporting on growth and technology, and between the iron curtain between China and US also seems to be abide a little by they allowing US regulators into China for on-site inspection, just the first step to comply to US laws. So you can see that the ice is definitely melting in that sense.
Thanks, Adrian, for
Yes.
sharing.
Yeah.
Right, so I think right now a lot of the Chinese stocks were being beaten down, right? Even the big cap stocks, right? So in terms of valuation and performance, what's the possibility of having a rebound inside?
Yes, Ethan. So in terms, when we talk about growth, and technology definitely is talking about growth. And when comparing growth to growth, we definitely want to compare, China tech growth sectors and the US growth sectors as well. So if you're looking at the valuation of the Hang Seng tech companies versus the Nasdaq companies, so you look at the Hong Kong stocks, the valuation of the top 10 Hang Seng tech index constituents versus US stocks and the valuation of those within the Nasdaq 100 itself. And you could see that in terms of valuation, they are in the lows, below, they're around, highest even they go is just only about 30 times PE compared to the US in terms of valuation, right? Like Tesla is actually about 96 times PE ratio. So you could see that in terms of valuation, probably because Hang Seng Tech has actually fallen a great bit, and that's why the keynote, the stress here is actually the valuation is actually much fairer and more affordable compared to the US counterpart, right? And the next slide, please. And you could see that, in the house view for CSOP, we definitely want to overweight Chinese tech sectors in the offshore market. So based on three basic reasons that, the regulatory concerns may have faded already. Sentiments has definitely recovered, and there's also a limited downside. The Hong Kong technology stocks has been pricing too many pessimistic expectation before, and it seems that if you look at the price channel denominated in blue, that is actually the Hang Seng Tech Index, right, has actually broke the downtrend channel already. It's actually starting to create a higher high itself. Right, comparing to Nasdaq itself, 100, right, you could see that right now they could only begin, their downtrend downwards, because on the mid, higher interest rate environment within the US itself. So we believe that we probably want to be underweight in terms of US, because right now the valuation is still very high on the back of like more and more in interest rate hike going forward. Right, that would definitely affect the Nasdaq more than the Chinese tech itself. So we believe that right now Chinese tech is actually bottoming out, and we believe that right now it could be, there is a potentially with the chart looking, it definitely points to a rebound at the moment. Yeah. And the next slide, please. So what would definitely be the strength in terms of the rebound, right? Share buyback, when companies are buying back their own shares after it's fallen, it definitely is going to lead a rebound. And in 2021, the accumulative kind of repurchase amount by the Hong Kong stocks is actually reached about 37 billion Hong Kong dollars, right? And internet is definitely one of the most active industry in terms of the share buybacks, with Tencent, Xiaomi, becoming the kings of buybacks, right? Historical data that we actually done for our quant team is that whenever there's a buyback wave in the Hong Kong stock markets, right, often occur near the bottom area, right? Whenever that happens, it often happens in the bottom area, and then the Hong Kong stocks itself rebound significantly, right? So these are some of the examples. If you look at the table, right, in 2018 to this year, right, where Hang Seng Index actually performed really poorly, and there is actually a repurchase. Definitely there's a market rebound. So for example, in 2008, definitely was down about 40%. That's where there's a lot of share buybacks activities. The market rebound by 52%. Right, so actually more than cover back the losses, and actually came up positive as well. So right now the share purchase size for the tech leaders in 2021, Xiaomi did 343 million shares, Tencent did 5.8 million shares, Alibaba did 10 billion, NetEase 5.05 billion, JD.com did $3 billion. These are actually committed by them. The next slide, please. Right. So I give it to the big heavyweight constituents within Hang Seng Tech itself when they do the share buybacks, right? So the columns in dark blue is that what they do. That's when they actually did their share buybacks, and Tencent did the two first tranche, right? Back in 1.8 and 1.9. That's actually could see that that's actually the market is actually probably near the bottom as well. After they did two share buybacks, the market for Tencent price we actually recovered. So right now again from the high, they are coming down again. They are starting to actually do a share buyback again. So potentially we could see actually a rebound going forward. Likewise for Alibaba as well, the two previous lines, but market was actually at the bottom, and they definitely did a share buyback then, and as you can see the market actually recover. As the price retrace, Alibaba has actually committed more money to actually do a share buyback, and definitely we could see a rebound going forward for Alibaba. And these two are actually, the heavyweights definitely is going to be a positive sign for the Hang Seng Tech Index itself.
All right, Adrian, thanks for sharing. I think it's very interesting when you share the valuation comparisons of those leading tech companies in China versus the versus the tech companies in US. So I'm quite surprised to see actually Tencent being trading at 15 PE only. So right,
Yep.
of course, I think our investors' mind, right? Of course, if you're taking a look just at individual stocks itself, that definitely pose a certain type of risk, right? So if you would like to, see it as an optimistic shift in renewed optimism in the Chinese market, right? So I would say that the world's first and the largest Hang Seng Tech ETF, that means it's constituted most of the tech stocks, right? Which is listed also by CSOP, right? So this is listed by CSOP in Hong Kong. The ticker code is 3033, right? So if you would just pull up your our investing note app or on our platform, right? Just search the ticker code at the search bar 3033, right? So this is the Hang Seng Tech Index ETF provided by CSOP Asset Management, of course, right? So this is, of course, listed on the Hong Kong Stock Exchange main board, right? So, just a shout out for this ETF, right? So this has quite a high daily turnover, right? So it's pretty liquid, and also this has quite a bit of tight bid and ask spread, right? So having a tight bid and ask spread means that you can get possibly better total returns. All right, so this is the investment strategy is actually a full replication strategy, right, of the Hang Seng Tech Index. All right, so if you would like to check it out, just go to the website 3033, right? You can see that actually there is some form of indication that it will rebound. All right, so these are for the audience that are watching that are optimistic on the situation of China tech stocks. Okay, so let's move on from there, right? So I think we are now in the second part of the session, right? Which we will move on to talk about dividend play on the focus on the REITs, right? I think there's no running from REITs when we're talking about Singapore, right? Thank you, Adrian, for sharing the part on the global macro, Singapore, Hong Kong, and China. So let's move on to this part, right? So the next question, right, is REITs, right? Of course, in everybody's mind right now, when you're watching this, hawkish environment, high inflation, right? What's the extended impact on REITs? Bruce, can we have you answer this question?
Yeah, sure. Hi, and thanks for the question. I think this question is quite relevant to the current market environment, and we believe the still high inflation and the higher interest rate will continue to negatively impact the REITs. For example, regarding the inflation, the higher electricity cost will have some negative impact on margins or DPUs for some REITs, particularly for those industrial REITs and data center REITs, which have a high electricity needs. But some assets can still pass through those high inflation pressure. For example, the retailers, their retail rents will benefit from a higher inflation because they will be able to adjust prices more rapidly, which means the rents itself will be part of the CPI. And of course, the higher interest rate would also negatively impact the REITs, mainly in two dimensions. One is about the potential higher interest cost, and the second one is about the negative sentiment on the market if the hikes are aggressive. But we have to bear in mind that the long end rates may not increase as fast at the short end. So we may be able to see a flat or even negative or inverted yield curve if the Fed the Fed current aggressive tightening dampens the future growth outlook, like Adrian mentioned, the potential recession risk. And if such, market scenario happens, REITs that definitely can be viewed as defensive plays as their rental income is secured due to their longer leases. I think this is particularly true for those large and mid-cap S-REITs, which still perform very resiliently in year to date. If you turn to the next slide, you can see that even Singapore inflation is expected to have a higher reading in the next 2 or 3 years, but the expected dividend yield of the S-REITs can still outperform these potential higher inflation, which provide a very good hedge against inflation. So it will be quite defensive.
Right. Thanks, Bruce, for sharing. I think it's interesting to see that there are actually multiple views on which sectors of REITs that are less impacted than the rest. Right. So let's move on to the next question. Right. So I think for the audience who know what happened lately, right, at least for the last 2 to 3 weeks, there has been a sell down in the trend of certain data center REITs lah. So, Bruce, can we get your insight on this?
Sure. I think it's mainly driven by one large US data center REIT, the sell-off of it, because I think the investment themes behind is that such data center REITs may face some tactical challenges because even their customers becoming their biggest competitors. For example, because of the large negotiation powers of those hyperscalers such as Amazon and Google, these definitely cause some potential declines in the rents and diminishing our returns. But specific to the Singapore data center REITs, I think there are still some mitigating factors, particularly the tight supply, thanks to the lack of supply of the data centers in Singapore over the past few years because of the government's control, and also thanks to their relatively long weighted average land leasing expiries. So the Singapore-specific Singapore data REITs are still quite defensive. And more importantly is that the carrier-neutral data center can still be the critical partners for different operators and hyperscalers. So that's so the in-source may not dominate all the market shares. So on the positive side, some data center REITs still offer some downside protections, earnings resilience, as concerns of the slowing growth next year increase. But there's still some downside risks. One of them is the ability to pass through the high electricity cost, and also the ability to pass through the high interest cost, and also the potential tenant risk cannot be overlooked over the next 12 months.
Right. So I think, Bruce, very insightful data down there, because I think higher electricity costs, this inflation, right, and higher interest costs, it remain as a concern, like you mentioned. So if, right, the next question is, if we were to see this as a sector rotation, right, can we get an indication of what's going to happen next?
Yeah, I have to say, currently the big topic is still we are facing the fastest pace of the Fed rate hikes in 40 years.
Yes.
So, generally speaking, we should still avoid REITs with high gearing and high percentage of the floating rate debt. But the good news is that most of the largest and S-REITs, Singapore REITs, they have a relatively low gearing, for example, below 40%, and have a relatively high ratio of their fixed debt. I mean, the liability, which can be more defensive versus the current higher interest rate. But specific to this potential sector rotation, we still believe the industrial REITs they are enjoying tailwinds from the structural growth. But within this industrial REITs, we think now value industries are more preferred. This is because as I mentioned, is because the increasing risk of the 2023 slowdown. And in terms of the growth industrial risk, we have to say currently, due to the higher interest cost environment, the acquisition opportunities become very limited. So we are more neutral on the growth names. But and in terms of the office rates, on the positive side, there are some double-digit jump in the office rents over the next 2 years. But the distribution per unit may be more flat because of the higher borrowing cost. And if you turn to the next slide, the hotel REIT, actually the recovery is in progress thanks to the continuing reopening in Singapore. But again, the positives were largely priced in, and the risk also heading into the downside risk heading into the next year, because once those positives are priced in, what will be the next trigger? I think we of course we can wait the China to reopen again, but it still takes some time. And in terms of the retail rates, I would say that the tenant sales for suburban already back or even higher than pre-COVID levels. And the good news is that the city center malls are currently benefiting from the return of office workers like us, but higher cost of living and mortgage rates can still be a headwind. So all in all of these, we are pretty much neutral for all of the major sectors, but we still like the value industrial names. I think that's in line with our underlying our Singapore listed REIT ETF underlying benchmark, in this slide, because currently they're still dominated by the largest value names of the industrial REITs, followed by some office and retail REITs in the key areas in the country. And in terms of the geopolitical breakdown of our investment for now, even we invest all our our money in S REITs, the Singapore listed REITs, the underlying revenue source is beyond Singapore. It can be in APAC or even in Europe and in the United States. But investors can still enjoy the tax efficiency of S REITs, but have more international exposures.
Right. Thanks, Bruce, for sharing. Right. So I think the question on everybody's mind, right, is can REITs investors still find bulls, even though the bulls are they can be sleepy bulls or slow bulls, right? Amid such market uncertainties.
Sure. I think under market uncertainties, instead of looking for a bull, I would rather to recommend a diversified portfolio instead of let's say put all the eggs into one basket. I think it is very important. In particular, we are facing the higher interest rates and high inflation, or even the growth pressure, because a diversified portfolio can help investors access both the cyclical names, for example, they may benefit from the reopening theme, and also the defensive names. But if the growth if it truly slows again next year, then this kind of diversification can provide some downside protection. But if the market still does well, then investors will not miss much upside. And the diversification can also mitigate the concentration risk of holding one or only a few REIT names, which means your volatility or maximum drawdown will be much more moderated. And getting this beta exposure will definitely help investors to, taking our ETF example, could getting the growth of these liquid and large mid-cap S-REIT names. And historically, those names outperform their smaller peers. If you look at the next slide, as you can see here, the large and mid-cap as highlighted in this how to say, the red rectangular, it's actually outperformed their smaller peers in the past 7-8 years. I think there is a obvious advantage of the scale advantage, because for those largest names, they can acquire the properties more smoothly and lead to a larger market cap, and then in turn to lead to a more stock or REIT trading liquidity and better valuations. And once they have all those benefits, they can raise the equities or other funds with a cheaper cost, and then acquire more quality properties. And in the next slide, actually, we summarize some qualitative reasons why large and mid-cap S-REITs outperform. First of all, is that this is quite specific to Singapore REITs because most of the Singapore S REITs we hold, they are government. They have the government-linked sponsors. I can tell you the rough number. It's around 70% of the holdings have a government sponsor background, and for those names, they have a quality, newer, well-located, and dominant assets, which help them to achieve the operational efficiencies. And their sponsor pipeline is quite broad, not only within Singapore or within the region, but also has a global outreach. So all of this will help them to achieve a potential yield spread advantage. And since their leverage is still not that high, still below 40%, so there's still some headroom for them to raise more debt, because currently under the regulator guidance, they may raise their leverage ratio to 45% or even to 50% if some conditions are met. So there's still some room for them to further expand. I think the large and mid-cap S REITs also imply one thing about the liquidity advantage. If you look at the next slide, which means we not only hold the largest size, but also hold the most liquid names, which means our index will overweight those names which are more actively traded, but underweight those names which are thinly traded, or even we can remove them if they are they fail to meet some certain criteria. So all in all, we have a very good underlying large and mid cap plus the liquidity screening, which means our product also quite tradable. And in the next slide, I want to re-emphasize the yield advantage of the S REITs. It's not only better or stronger than the current inflation rate, but also or even higher than STI dividend yield and higher than the Singapore 10-year yield, and of course higher than the Singapore fixed deposit rate. So it's quite defensive assets with some attractive yield pickup at the current stage. And in the last page, I will highlight a snapshot of our Singapore listed S-REIT leaders index ETF. There are two counters, one SGD counter, SRT, and the other one is a US dollar counter, SRU. Currently, we accept both the secondary trading, which is just starts from 1 unit or slightly below the 1 Sing dollar. So it's an entry threshold quite low. And we also accept the creation, which also has a relatively low threshold, which is just around 50,000 units or slightly less than the 50,000 SGD. Our dividend distribution policy is semi-annually, and I'm glad to say that today it's our ex-dividend date. We have a roughly 2.8% dividend yield, but since we pay the dividend half yearly, so if you multiply by 2, the annualized dividend yield is around 5.6%, which is pretty much in line with our benchmark expected dividend yield. And since I think some of the investors may already miss this one because today is the ex-dividend yield date, but the good news that starting from tomorrow, the new round of the accumulation of the dividend starts. So it's never too late to try this ETF. And currently, our management fee is at 0.5%, and we will cap our TEI at 0.6% regardless of ETF size. Thank you.
All right, thanks, Bruce, for sharing. I think that's very comprehensive breakdown of the CSOP IHS REIT Leaders Index ETF. So I think everybody who's watching, you probably need to take down the two counters, which is SRT and SRU, right? One is denominated in SGD and the other one in USD, right? So I think let's move on to the final part, right? What are some key takeaways from this market outlook, right? So I think for us, just now we mentioned, we actually asked the question, right? Where are the bulls, right? So I think Bruce put it very nicely. Instead of looking for the bulls, right? Like what those investors, was it Warren Buffett who said time in the market is better than timing the market. I'm not sure who said that, but there's a saying going to show, right? So Bruce, I'd like to ask, what are some of the key takeaways? Both Bruce and Adrian.
So Bruce, you want to take the S-REITs one?
I'll leave it to you. I think you're quite familiar with this.
Thank you. Yes. So I think for the key selling point of our S-REITs leaders index ETF is actually what Bruce has mentioned. Is actually we are putting 28 large and mid cap S-REITs into this ETF, right? So these large and mid cap S-REITs are actually backed by government, which actually have easier access to more dominant assets, very strong sponsors, and very strong management, right? And because of they're huge, you're able to negotiate in terms of borrowing costs, rising interest rate. It's a key concern, but definitely with them being a large S-REITs, they definitely have the muscle to actually negotiate and lock down their interest rates in a longer tenor, fix the interest rates and lower their interest rates for a longer period of time. So and then that offers investors a higher opportunity for growth, right? Based on statistics shows that true enough, during COVID-19 everything fell, but our S-REIT leaders index recovers so much faster, so much resilient, displays so much resilience because of these qualities. Right, and we also put in a bit of a mid cap, just to increase the dividend yield. And this mid cap S-REITs of course offers investors stable cash flows, sector diversity. If you funnel these two advantages into this ETF, right, give investors cost and tax efficiency, because dividends you will not get tax as well. And based on Bloomberg estimate, the index level dividend is about 5.6 for full year for this year, minus off our total expense ratio of 0.6, which is the maximum. We are capped at 0.6. You're still getting 5% by 5% dividend yield and owning 28 big names as well, right? The Bruce also did mention about a liquidity adjustment, and how it does is actually, in between rebalancing, we look at which ETF is actually being actively traded, right? Contrary to traditional index tracking, you bigger the market cap, you get more you get index weight. We look at the trading activities between rebalancing. Actively traded means that investors are looking at particular sector, particular REITs, right? Then we do this. Actually are some of the fund flows. So we use this liquidity, rebalancing kind of structure to make our index and ETF more robust, to track which sectors that's actually more representative of the current situation. And that's why the key unique selling point of it is actually we use liquidity in between rebalancing to help us to have passively exposure to sector rotation. So you just buy this ETF, you just wait, let the index and let Mr. Bruce Zhang to actually rebalance the portfolio to give you the right sector rotation. A passive, just sit back, chair, and then let us do the heavy lifting. Diversification as well in terms of geographical and sector rotation, very low volatility and strong turnover for this ETF itself. So that's for the S-REITs. For the other boost is definitely we look at the horns are coming up for China market as well, especially the tech sector, because technology is one key part for China to hit their 5.5% target growth based on their fiscal and monetary policies. Yes.
All right, thanks, Adrian, for sharing. So I think one thing to add on for this REIT ETF, right? I think the good thing is really about the liquidity adjustment rebalancing. Because if you are, an investor that buy individual REITs, right? Yes, you probably can do that as well, but it will not be first cost effective. Number two, you have to be very in tune with the market, right? Because you have asset management firm CSOP to actually do the rebalancing, then it's well taken care of. But if you're an individual investor, you might have a problem doing that because it's very time consuming, right? So the next point that I would like to add, because as a REIT investor myself, some of the times, some of these REITs, right, will have a lot of different corporate actions, right? I think corporate actions got good and bad, but sometimes there are some not so good corporate actions that might require you to like a rights issue or what. So this ETF actually does take care of that automatically lah. As a investor in the ETF, you don't have to really worry about that. So I think that's one key USP about this ETF. So I think just to add on, if you came into the webinar late, earlier part of the webinar, we were talking about China and the Hong Kong markets, where the valuation of this tech stocks for the Chinese tech stocks, right, are trading at a very low PE, significantly lower than their US counterparts. So I think if you are very optimistic about the China's rebound, right, because it has been battered down so much, you can take a look at the ETF, CSOP's Hang Seng Tech ETF. You can search on Investing Note or just Google it. It's 3033, right? Just search CSOP ETF 3033, right? So it'll give you all the data, and of course, it's an ETF that is listed on the Hong Kong market. So shout out to the CSOP 3033 Hang Seng Tech ETF. All right, thank you. So right now, before we go into the Q&A, right, there's promotion that is coming up about this. Maybe Adrian, you want to share more about this?
Yes. So, we believe in our ETF so much that we have actually partnered with Phillip Securities to do a campaign, to help you guys to kickstart your regular savings plan into an ETF that will definitely give you stable and regular income, right? So, for every $200 invested via the regular savings plan with Phillip Securities into our IHS REITs Leaders Index ETF, we would actually sponsor 6 units itself, to give you a little boost in terms of to kickstart your regular investment journey, to build your portfolio into the REIT space itself. So this is a current campaign that we're going on. That's going on with Phillip Securities. Do scan the QR code. You definitely could sign up online onto their Poland's platform. And at end of the 3 months, they will actually notify you that you got the bonus units. Yes.
All right. Thanks, Adrian, for sharing. I think many of our viewers and community members can benefit from this. So actually, take out your phone, give it a scan, and take a look at it. All right, so let's move on to the last part, which is Q&A, right? So I'll be picking some of these questions. So let me take a look at these questions. I probably need to look at the questions while I stop share. All right. Okay. So I think one attendee is actually asking, I think it's directed to Adrian, right?
Yep.
Anonymous attendee, right?
Yep.
Hi, Adrian. Just to understand more, what are the impacts of the inverted yield curve to the stock market? How will this affect the economy as a whole?
Right. Maybe, Bruce, do you want to take this?
Yeah, let me try to jump in because I think these rate hikes not only impact the bonds, but also they impact the equities. I think just as mentioned, the inverted yield curve, at least in history, observations, they imply some potential recession risk in the United States. But specifically to some Hang Seng Tech or Chinese high-tech stocks, I think the story can be quite different because on the one hand, China has a quite independent monetary policy cycle versus United States, which means the current Fed tightening, which can have a large let's say potential recession risk based on historical data, it doesn't necessarily means these will impact the China high-tech stocks on the same pace, because at least for now, the Chinese authorities still tends to be more neutral or a bit easing on the easing bias. And secondly, it's about the recent relaxation of some of the previous crackdown on the China tech sectors, which is definitely positive. I think the logic behind is that on the back of the still challenging, let's say the Omicron or other variants of the COVID situations, that China has to use all the weapons at its hand to support the economy. It's not only limited to the monetary policy I mentioned, but also the fiscal policy and the specific in the sector policy to support the China's high-tech stocks. So I think even the current inverted yield curve, or the let's say, or also the hawkish comments from the Fed, which may impact the sentiment of the stock market. But from a fundamental perspective, I think Chinese tech stocks would still get some support.
Right, thanks, Bruce, for sharing. So the next question, right, by Mr. Anonymous Attendee again, right? Tech stock is actually at PE 20x. I think he was referring to the Chinese tech stocks, right? With the prolonged downtrend, do you think this is a good opportunity to collect more? Maybe Adrian, you want to, yeah,
Yes.
maybe perhaps he wasn't paying attention.
Yes, I think if you look at the maybe I could trouble you to show the slides again.
Sure, just give me a minute. Let me go to the slides. Give me a minute. Let me power it up again. Right.
Yep, definitely slide 23 is definitely in terms of yeah, I think right, I think 24, slide 24 is definitely a good one. I mean, looking at trading channel, right? I mean, the definitely the Chinese the Hang Seng Tech definitely has actually started the downtrend much earlier than comparing to Nasdaq itself. And if you I think based on I think the picture tell 1,000 words. I think if you want to pick up some of the tech stocks, it seems that the Hang Seng Tech is definitely a better candidate, potentially a better candidate compared to the Nasdaq part, right? Again, we are overweight the Chinese tech stocks in offshore markets. It's because of the regulatory concerns may have faded, right? Investor sentiments for the Chinese tech is definitely recovering. We saw a bit of high turnover for Hang Seng Tech sector itself. Definitely a very limited downside because most of the pessimism has actually been baked into the price already, and you could see that the blue line, this blue chart is actually the Hang Seng Tech. You could see that the price actually break through the down channel. For Nasdaq itself, it definitely seems like definitely a start of the downtrend itself. Yep.
Right. Thank you, Adrian, for sharing.
Yes.
So I think we have one last question. I think many questions. Okay, so people who have joined halfway, right? There is a replay. It'll be on YouTube. Okay, so not to worry. So one last question. For SRT, which is the CSOP REIT, IH REIT ETF, can we use CPF and SRS to purchase? CPF IA account, OA account, yeah.
Yeah, I think for CPF, they need a 3-year track record. So we are try our best to build the track record, because we only have 6 months, so 6 to 8 months. But for SS, yes, my answer is yes. You can use SSS account, tax-free account to purchase SRT.
All right, thank you, Bruce, for sharing that. So you have it. All right, so I think we are a little bit short on time. So I guess if you have any more questions, right, you have to tune in for the next webinar, because I think we have more than close to 20 questions here, right? We can't possibly answer all of them, but not to worry, right? You can always catch the replay if you missed out anything, or if you came, joining us late. Right. So thank you very much to our special speakers, Adrian and Bruce, for their comprehensive sharing. So without further ado, I wish everybody a very great evening, and stay tuned for the next webinar that we're going to have pretty much very soon. All right. Thank you, Bruce and Adrian.
Thank you everyone for joining us tonight. Thank you, Ethan, for organizing this. Thank you so much.
All right. We'll have the replay up on YouTube very soon. All right. Thanks, everybody.
Thank you.
Have a great evening. Okay, bye-bye.
Bye.